All right, looks like we are live. So I'm going to talk about the craziness, more rules changes. Again, the Fed is truly desperate, trying to cushion, as I wrote in my article from my Patreon account contributors last night, trying to cushion the corporate bond bubble because of the cash flow problem and other problems in the real economy. But before I talk about that, let's talk about the official Fed balance sheet today and then the jobless claims numbers. So the official jobless claims numbers were, let me get it here, the 4.8 million rise in non-farm payrolls in June provides further confirmation that the initial economic rebound has been far faster than we and most others anticipated, said Michael Pierce, senior U.S. economist at Capital Economics. But that still leaves unemployment 9.6% below its February level, and with the spread of the virus accelerating again, we expect the recovery from here will be a lot bumpier and job gains far slower on average. So the non-farm payrolls, this is a CNBC article, Jeff Cox. I read from another article there briefly. 4.8 million, supposedly 4.8 million in June. We'll get to the real numbers in a second with John Williams of ShadowStats and Mish Shedlock from Mish Talk. 4.8 million in June, much better than the expected increase of 2.9 million. The unemployment rate fell to a crisis low of 11.1%, also better than the 12.4% estimate. Those on temporary layoff fell by 4.8 million in June to 10.6 million after a decrease of 2.7 million in May. Total, we are at 15 weeks now and way over 47 million unemployed. But they're going to spin it any way possible because the election is less than 6 months away, and I think that's one of the reasons why the corporate bond interventions are going to get absolutely crazy. So the real numbers from ShadowStats are much, much worse. According to John Williams of ShadowStats, 1.9 million unemployed were added to the employed category. So that's what cooked the numbers. Now, the Bureau of Labor Statistics disclosed this, and they just didn't cover it in any of the mainstream media at all, of course. Mainstream financial media, President Trump and his Trump supporters didn't cover that at all, unfortunately. But that actually is a decrease in the manipulation of the jobs data because they were talking about 4.9 million Americans that were unemployed that were moved over for the last 3 or 4 weeks now that were counted as employed. So they're manipulating less. As Keith McCullough of Hedgeye would say, the rate of change is decreasing, although the rate of change involved manipulation. If you want to read more about the jobs numbers, what the official numbers are, and the sugar-coating, the non-sugar-coated numbers, Mish Shedlock also went through it. He says unemployment is much worse than it looks. The unemployment rate fell 2.2 percentage points to 11.1%, but claims data and the reference week raised significant questions. Earlier today, he commented that jobs, questioned both the strength of the rise in jobs and the decline in the unemployment rate based on claims data and the reference week. The household survey week, which sets the unemployment rate, is the week that contains the 13th of the month. Some claims data released today is for the week ending June 13th, but first let's discuss the lead chart. Continued claims, which are people that have been unemployed for longer than a week, have shown that little improvement for 5 weeks now on May 16th. Continued claims were 20.841 million. There were 19.290 million for the week ending June 20th and 19.231 million on June 13th. These are seasonally adjusted numbers. Also, if I could, I just remembered this with the John Williams of ShadowStats numbers, he still has his unemployment rate using the old calculations at over 31% unemployment. So it is down slightly. I think it was over 34% unemployment in the last week or two. That was, I think, the highs, and it's down to 31.2% unemployment. Continuing with the Mish Shedlock article, these are seasonally adjusted numbers, and they rose since last week. State claims are the best single reference point. Those claims represent people eligible for unemployment at the state level. So the primary PUA claims is still rising. There's good charts here in the Mish Shedlock article. The article will be below this video in the information and description section afterwards. So when the global pandemic hit, various unemployment compensation schemes hit at the federal level, notably PUA. People are eligible for PUA based on lost income and forced part-time work. So not everyone on PUA, which is not pickup artist, is technically unemployed, but some are. The numbers in boxes pertain to the reference. Okay, we'll just skip it. He's just referencing the chart too much and the birth death model. Anyways, the real numbers are much, much different than the headline numbers. And this is how you cook the books. The election season is coming up. So let's talk now about the Fed's official balance sheet. So the Fed's official balance sheet, and you can follow George Goncalves on Twitter at Bond Strategist. So it's Bond and then Strategist. He, every single week on Thursdays, he goes through pretty quickly in a couple tweets. He just gives you a good summary of the Fed's official balance sheet, what has changed. The Fed's official balance sheet, despite how the U.S. Treasury is borrowing an insane amount of funds in just the last 3 or so months, $3 trillion approximately, is actually down. So the Fed's official balance sheet is down again, another $74 billion in 1 week. And he said the currency swap lines, which are outstanding to the European Central Bank, the Bank of Japan, the Bank of England, some emerging market countries, are down significantly. However, the bank reserves, what is interesting is the Treasury, the TGA account, the Treasury General Liability, and that's going even higher. It's even higher than when George Gammon did the video on it in the last 10 days or so. So now the TGA, Treasury General account, is up to 1.656747 trillion. That is nuts. You can't even see it's parabolic. It is a straight line up. And the bank reserves are falling still. So these are the reserves that the large banks have at the Fed, and those are falling. And this is something that you can expect because the banks, there's a really good interview with Hedgeye's bank and financial and credit analyst that was released on their YouTube channel in the last couple days. It's about an hour long. And he's talking about how the banks they're in a lot of trouble with consumer credit and the commercial real estate problems. So the banks are going to start blowing through reserves. Yes, coming into the global pandemic and the crisis afterwards, the financial aspect with the lack of cash flow and the problems in the real economy, the banks did have a lot of cash, but now their customers are either not able to pay rent or going broke, or look at all the bankruptcies that we're seeing in the headlines. So the banks are getting killed with this. I think the next major shoe to drop, besides how the Fed is cushioning or trying to cushion the corporate bond bubble, or trying to engineer a soft landing, the next major problem is the commercial real estate bubble. And I don't know how the Fed decides to deal with that. It's going to be very difficult because real estate is very heavily leveraged. Real estate needs cash flow to service the debt. And the write-downs on some of those assets could be many trillions if the assets become non-performing. Which means then the holders of those commercial real estate mortgage-backed securities, the holders of the real estate, they're going to be in a lot of trouble. So we'll see what the Fed decides to do. Maybe the Fed's official balance sheet, or maybe the Fed will stop reporting it on the official balance sheet because, if the Fed's going to buy all these corporate bonds and their balance sheet, according to one of my Patreon account contributors, he was like, the Fed, I haven't checked the exact numbers on this, but he was saying the Fed has only bought about 1% total out of all what they've promised in the press releases over the last 3.5-4 months. So if they're going to keep promising all these things, eventually they're going to have to buy some of them, although maybe not as much as they're claiming they're going to have to. And that's the Fed's balance sheet's going to go absolutely crazy if they're going to try to engineer soft landings for the corporate bond bubble and the commercial real estate bubble. The Fed's balance sheet's going way over $2 trillion then. Way over $10 trillion. I don't know why I said 2. Way over $10 trillion then in the next 12 to 18 months. It's going to be a mess. The commercial real estate bubble, that's the problem with leverage, using a lot of debt on real estate. Without cash flow, things get ugly very, very quickly. Jeff Gundlach is warning about the real economy. He's not optimistic. A few days ago, we had the Chicago Purchasing Managers Index numbers. The biggest miss in 5 years. As the V-shaped recovery, the odds of it are low. So this is the biggest miss of expectation since February 2015 for the Chicago Purchasing Managers Index. So that means that people at manufacturing companies, suppliers in the global supply chain, in the supply chain in the U.S. are not ordering goods. They're not stocking up inventory, probably because they're not expecting consumer demand for a lot of items. Another interesting thing that I wanted to bring up was who bought the treasuries this week. So let me pull it up here. George Goncalves, wrong George. George Gammon is crushing it though. Shout out to George if you're listening. George Goncalves, he pulled up who bought the treasury issued in June, $872 billion, and the Fed only bought $61 billion. Shocker. But the private market bought $811 billion. So that's interesting. Maybe it's what Jeffrey Snyder was saying, how they need those treasuries for collateral, so they can do their hedge fund trades and hedge fund leverage trades for currencies and bonds and derivatives, because treasuries are considered the highest quality collateral. Finally, let me get into the main part of the article here. I'm not going to read Jeff Gunlock's comments. The other articles will be below the video in the information and description section. Big Tobacco, this Reuters article was from Sunday. Big Tobacco, Big Oil, and Buffett joined the Fed's portfolio. The U.S. Federal Reserve bought $428 million in bonds of individual companies through mid-June, making investments. So it's a small number. I know it sounds large, but compared to all the other commitments and press releases, it's really not that large anymore. I mean, we're talking trillions. The problems are in the trillions now. If you want to talk about the derivatives market, the problems may be hundreds of trillions or over a quadrillion. Making investments in household names like Walmart and AT&T, as well as in major oil firms, tobacco giant Philip Morris, and a utility subsidiary of billionaire Warren Buffett's Berkshire Hathaway Holding Company. So why are they buying corporate bonds? Things must be much, much worse than they're letting on. Why are they buying corporate? But Warren Buffett's Berkshire Hathaway supposedly has almost $140 billion in cash, unless a lot of his investments that are tied to commercial real estate are in much, much worse trouble than the public is aware of. The transactions disclosed Sunday are the first individual company bond purchases made by the Fed under new programs set up to nurse the economy through the global pandemic. The Fed also added $5.3 billion in 16 corporate bond exchange-traded funds, including a newly added 6th high-yield fund. The initial round of purchases included some 86 corporate bond issuers, about half of them contractually settled as of June 18th, and some still underway, all bought on the secondary market, which means that hedge funds and investment banks and family office managers and high net worth individuals and clients of Goldman Sachs are front running all of those trades. They probably, a good amount of those guys probably got a list of the bonds the Fed was going to buy before they bought them, because this is how messed up everything is. The corruption, fiat currency. That is a small slice of the more than 790 corporate issuers whose bonds the Fed has said in a separate press release were eligible for purchase. So the Fed is willing to buy, and the rules can change. Again, this is another rules change. 790 different corporate bond, oh my gosh, this is just so ridiculous. 790 different corporations are eligible to have their bonds purchased. Unbelievable. Just something crazy. There's a new craziness every day. But it was still a first foray into corporate bond purchases that spread broadly across the economy, touching firms like Gilead Sciences that are involved in developing ineffective treatments for the global pandemic. If you watch Chris Martinson videos, Remdesivir, which is going to be overpriced and a scam, and there's not enough human testing caused by the global pandemic, as well as major automakers that included Ford Motor Company. This makes sense, what they're doing, because Ford has a lot of auto workers. They're union protected. There's a lot of American factory jobs there, and also the auto industry is in big, big trouble. I would not be surprised if we see another cash for clunkers. Remember, Ford was they had their credit downgraded, I want to say 2.5 months ago, maybe a little bit longer than that. It was downgraded to junk bond status. So the auto industry, other than Tesla Motors and Nikola, the auto industry is in big, big trouble. The reality of the auto industry, because Tesla and Nikola, they don't really have much going for them in reality. That included, especially, I'm not going to go there. We'll get way off tangent. That included Ford Motor Company, whose credit was downgraded to junk status after the Fed announced its intent to buy corporate debt. Both the Bank of Japan and the European Central Bank have programs to buy individual corporate bonds, but the Fed only added that to its arsenal in light of the depression-level risks posed by the global pandemic. The aim is to ensure companies can continue to finance themselves. I thought the Fed already did this. They issued all the press releases in March, late February and March. So all these large corporations, the first week of April, they raised $110 billion, a record in a week of corporate bonds, and that's still not enough? And I think those were mostly investment grade, a lot of those corporations that raised that amount of bonds. So you know things are bad. The corporate bond bubble, we've been warning about it for at least 18 months, probably 2 years. It's a big, big mess. Now, the Fed is, like I said earlier, trying to engineer some type of soft landing, cushion how bad it's going to be. They're pulling a ton of levers. The odds of success of engineering a soft landing and cushioning everything, I think the odds are pretty low. But we'll see. I mean, if they're going to keep changing the rules and they're going to expand it to over 790 different corporations, who knows? And also, remember, the election is coming up. So President Trump is probably putting a lot of pressure on the Fed, saying this is the major factories in pro-Trump states or swing states. And if those factories go, the odds, if you look at the historical record, the incumbent, when there's a recession or depression and there's massive job losses or a stock market crash, the incumbent politician the odds of them winning the election go down a lot. So there could be a lot more craziness just because this is an election year and Trump is putting even more pressure than on Jerome Powell and the Fed and Mnuchin to come up with some type of scheme to save those jobs, those factory jobs. So I think that's why you have the Fed, at least partially the reason why you have companies like Toyota, Volkswagen, Daimler, which was a Zero Hedge article here, that they're getting some of their corporate bonds purchased too. Because I think it's because of their American subsidiaries. Because I may do a separate video on this showing the charts and graphs of the factories here in the US, the auto factories. There's a good amount of jobs of auto factories in South Carolina, in Tennessee, and other either swing states or pro-Trump states. So I think that's definitely playing a part. I'm not sure exactly how much of a part, but I think it's definitely playing a part. Okay, back to the Reuters article. Both the Bank in Japan and European Central Bank have programs to buy individual corporate bonds already, which has created zombie companies and also no bond vigilantes and also bond traders, either hedge fund managers or bond fund managers or investment bankers who are front-running all the central bank trades for easy cash, for easy profitable trades. And then they might leverage up those trades. And then if the Fed doesn't buy, if they guess wrong or they don't have inside information, maybe then they blow up because they've leveraged up. It's okay, the Fed will bail them out because the Fed bails out hedge funds now. But the Fed only large hedge funds. But the Fed only added to its arsenal in light of the depression-level risk posed by the pandemic. The aim is to ensure companies can continue to finance themselves, not be forced out of business due to problems raising cash during a pandemic. The program is backed by investment capital from the U.S. Treasury to absorb any losses should corporations default. The largest purchases were bonds issued by, this is interesting, AT&T and the United Health Group, with the Fed buying around $16.4 million of bonds from each. Yeah, AT&T's balance sheet is a disaster. They did a bad acquisition with DirecTV, I want to say like 6 or 7 years ago. And I remember newsletter writers were talking about how smart it was for AT&T to diversify and buy DirecTV. They used a ton of debt and it's backfired. Issues in the energy industry accounted for about 8.45% of the bonds purchased, about a percentage point less than their representation in a broad market index that the Fed says its purchases are intended to track over time. The Fed's bond purchases and other emergency programs will be scrutinized. Yeah, there's going to be a congressman there waving the finger at them. More like the congressman's going to say, oh, this company or that company. Do you know what Maxine Waters did in 2008 when the Fed was bailing out large banks? Her and her husband had a very big investments in a local community bank, I think in the LA area, and she managed to get a bank bailout that was not supposed to have been gotten. And she was, they were claiming, they were going to bring her up on ethics violations, and she could lose her congressional seat. Yeah, it never happened. She got a bailout. So I'm guessing, if history is a guide, that we're going to see politicians in both parties. If the Fed's buying individual companies, they're going to figure out which one of their friends they can help or where their investments are. Although I think a good amount of people in Congress did dump their stocks, the end of January, in their intelligence briefings when they're finding out about the global pandemic. Some of them sold. Like Dianne Feinstein, I think the senator from Georgia, the Republican senator from Georgia. Okay, they're going to scrutinize. The Fed's bond purchases and other emergency programs will be scrutinized by lawmakers at a Tuesday hearing before the House Financial Services Committee with Fed Chair Jerome Powell. Questions may focus on the individual bonds purchased, but also on the fact that support for the bond markets used by major firms is now up and running and getting billions of Fed support, while the Fed's Main Street lending program for smaller companies has yet to make a loan. The central bank's programs overall have so far seen modest use. The central bank's overall balance sheet has declined for the past 2 weeks, falling to, this was from last week, so this is not updated. Welcome to dystopia. I have this other Zero Hedge article here about why is the Fed buying bonds from foreign corporations like Toyota, Volkswagen, and Daimler Benz. I already told you my answer. I think it has to do with the American subsidiaries and the factory jobs, because Trump's voter base, he's going hard after those factory jobs. He wants to keep those, and they're either in pro-Trump states or swing states, and he does not want the local economies around those factories to be devastated even more. And finally, my hero, Ron Paul. He wrote an op-ed about this on Monday, June 22nd. The Federal Reserve is getting desperate, talking about all the craziness with the bond purchasing program and how it's creating unbelievable amounts of distortions in all these different markets. You know, if the Fed is going to buy all these corporate bonds, then the equity, people are going to look at the equity prices as higher, saying that the company is not going to have as much solvency issues. And then, of course, Ron Paul, and I don't think this will happen again, he wants another audit of the Fed. I would love another audit of the Fed. I would like to see what the real balance sheet is, how much currency swap lines are actually outstanding. I don't believe the real number. I don't believe the number that they're reporting now. From what I've learned in almost 15 years and studying the 2008 financial crisis and interviewing over 500 experts and reading a bunch of books and thousands of articles and speaking to sources here in DC and New York City and elsewhere, in emails and on the phone, and then getting the one-time partial Fed audit that it's been descrubbed from the internet, the Fed audit. You can't even really find the articles on it. The one-time partial Fed audit. There's a lot, millions of Americans don't even know what happened. So I would love another Fed audit. I don't think it's going to happen. The truth is the enemy. As Ron Paul says, and George Orwell says similarly, truth is treason in the empire of lies. The Ron Paul op-ed is good. It's short. He says, in a sign that the Federal Reserve is growing increasingly desperate to jumpstart the economy, the Fed's secondary market credit facility has begun purchasing individual corporate bonds. The secondary market credit facility was created by Congress as part of a global pandemic stimulus bill to purchase as much as $750 billion of corporate credit. Until last week, the secondary market credit facility had limited its purchases to exchange-traded funds, which are bundled groups of stocks or bonds. The bond purchasing initiative, like all Fed initiatives, will fail to produce long-term prosperity. These purchases distort the economy by increasing the money supply and thus lowering interest rates, which are the price of money. In this case, the Fed's purchase of individual corporate bonds enables select corporations to pursue projects for which they could not otherwise have obtained funding, or leverage buyouts. I think share buybacks might be banned, but you never know. Obtain funding. This distorts, again, this is about Austrian School of Economics. We call about misallocations of capital, malinvestment, and distortions. There are unbelievable amounts of distortions. People are bringing up, oh, the bond vigilantes will come back. Not if the bond vigilantes are bought off and they know that they can front run the Fed for millions of dollars in fast money in a couple weeks or a month or two. Not if all these hedge fund managers that used to be bond vigilantes or these bond fund managers at investment banks or private family offices that used to be bond vigilantes, not if they know it's easy money and everything short-term oriented and rent-seeking and myopic. This distorts signals sent by the market, making these companies seem like better investments than they actually are, and thus allowing these companies to attract more private investment. This will cause these companies to experience a Fed-created bubble, also zombie companies, as we've seen in Japanese banks in Japan, where they did not allow Japanese banks to fail about 3 decades ago. Also, SoftBank is a mess. I think SoftBank is dead man walking, probably will need a bailout. And in the zombie companies, corporations, and European banks in the ECB, which I think the Fed has been helping keep on life support for probably 10 years. Because of the derivatives books. Okay, better investments than they actually are, and thus allowing these companies to attract more private investments. This will cause these companies to experience a Fed-created bubble. Like all Fed-created bubbles, the corporate bond bubble will eventually burst, causing businesses to collapse, investors to lose their money unless they receive a government bailout, and workers to lose their jobs. Well, in an election year, I think Trump is trying to stop workers from losing their jobs, but who knows how many trillions or hundreds of billions or trillions have to be created to just keep some jobs. Under the law creating the lending facilities, the Fed does not have to reveal the purchases made by the new facilities. Wow. No transparency. So Congress grilling them, I would trust Ron Paul rather than that Reuters article talking about Congress is going to grill them so good. Instead of allowing the Fed to hide this information, Congress should immediately pass the Audit the Fed bill. Thank you, Ron Paul. I love you. I don't think that's going to happen. I wish it did. I don't think we're going to get another Audit the Fed bill. We're lucky we got that partial one, and look, it's already been scrubbed from the internet. You can't really find the articles anymore. And I have financial professional friends, mainstream financial professional friends telling me that like they never heard it even happened. They're not even aware it happened. The Audit the Fed. The partial audit of the Fed. Congress should immediately pass the Audit the Fed bill so people can know whether a company is flush with cash because private investors determined it is a sound investment, or because the Fed chose to invest in, air quotes here, good, Ron Paul's having a little snark and some sarcasm, in its bonds. It's good to laugh a little bit. The Fed could and likely will use this bond buying program to advance political goals. The Fed could fulfill Chairman Jerome Powell's stated desire to do something about climate change by supporting green energy companies. The Fed could also use its power to reward businesses that, for example, support politically correct causes, refuse to sell guns, although gun sales are going crazy. You know the biggest area where gun sales are spiking? Democrat states, Democrat cities. That's where the big spikes are the last 4 months. Unbelievable. Maybe I'll do a separate video or a separate show on that with gun sales. It's nuts here in the U.S. Hey, if they're gonna defund the police, if you own a small business, a bricks and mortar small business, or a restaurant, or private, you want to protect your private property, and there is no police. Some people, if their lives are basically over if they don't have any private property or a business. Okay, well, I don't want to talk about that topic too much more. It's pretty depressing. Okay, require their employees and customers to wear masks or promote unquestioning obedience to the warfare state. Another of the new lending facilities, so program 2, is charged with purchasing the bonds of cash-strapped state and local governments. This could allow, which is promoting bad behavior by government, which will also, and the governments are still probably going to figure out new taxes to raise on you and then increase property taxes. This could allow the Fed to influence because governments don't know real economics or don't care. This could allow the Fed to influence the policies of these governments. It is not wise to reward spendthrift politicians with a federal bailout, whether through Congress or through the Fed, with lending facilities providing to the Federal Reserve the ability to give money directly to businesses and governments, which is the Fed picking and choosing winners and losers. The Fed is now just one step away from implementing Ben Bernanke's infamous suggestion that if all else fails, the Fed can drop money from a helicopter. I think we've already had a few helicopter money drops, and there's going to be more MMT checks and other crazy things to come because the cash flow problem pervasive throughout all levels of society, government, corporate, small business, family, individual level, not solved. And in the corporate bond bubble, which the Fed is pulling all these different levers, hoping to soften the blow. And then, of course, I think the next shoe to drop is the commercial real estate bubble. There is a lot of commercial real estate mortgage-backed securities. I'm wondering if the Fed's going to have to buy them all at 100 cents on the dollar. And the leveraged loans and collateralized loan obligations, too. Okay, these interventions will not save the economy. Instead, they will make the inevitable crash more painful. Well, they will delay it, which is normally the goal. Because a lot of people here in D.C., they figure out things will crash. I'll make my money now. I'll get a consulting job. I'll get a lobbying job. I'll make my 6 or 7 figures a year at that job. And when things blow up, I won't get blamed. Their goal is to just kick the can as long as possible. Eventually, you run out of road, though. The question, especially with the global economy and the mess that it is, the next crash can bring the end of the fiat money system. That would be awesome if the fiat money system ended. Unfortunately, it looks like a lot of politicians are planning for government cryptocurrency. Again, that's another video. I don't want to cover that now. The question is not if the current monetary system ends, but when. The only way Congress can avoid the Fed causing another Great Depression, I think we already have one, or actually making the Great Depression worse, is to begin transitioning to just like FDR did, and Herbert Hoover, both of them. Herbert Hoover made things worse. FDR made things worse. If you read what really happened in the Great Depression, Herbert Hoover was not a free market guy. He was a heavy interventionist. FDR ran on a small government, remain on the gold standard policy, and then, of course, he lied because he's a politician. And then he proceeded to double and triple down on pretty much all of Herbert Hoover's similar policies. Only way Congress can avoid the Fed causing another Great Depression, or prolonging the Great Depression, I'll add that for Dr. Paul, is to begin transitioning to a free market monetary system by auditing, then ending the Fed. That would be awesome. Unfortunately, it looks like things are going in the exact opposite direction. Welcome to dystopia. Okay, let's take a look at the live chat questions and super chat. Stream of thought, $7.77. You must be a fan of Boeing. Thank you for the super chat. If oil broke $100, I'm just kidding. I don't think you're a fan of Boeing. I don't think anyone's a fan of Boeing right now. If oil broke $100, unless you work at Boeing, and then probably still not a fan. If oil broke $100 per barrel, which oil industry segment would benefit most from price rise? Exploration, drilling, production, pipeline, refining, etc. So normally at much higher oil prices, oil refiners do not do well. Oil pipeline companies, they would do solidly. So a rising oil price, if oil is very volatile, the pipeline companies may struggle a little bit. If oil stays at a fairly profitable price or rises, the pipeline companies would do well. It really depends, in my opinion, on what your goals are if you just want income. Because there's a lot of people that are looking at the oil companies now for income. And I've been warning people about the pipeline companies that they were not good income ideas. I think one of the master limited partnership companies might be Energy Transfer. I think they just had a big problem. I think there's like a ton of lawsuits because the oil companies that they have contracts with in the Bakken, they're not putting the oil through the pipeline. Now the pipeline company's in trouble. I was warning people about this in February and March, that this was going to get bad. Because there was people telling me, oh, I'm parked in the pipeline companies for income and they're safe. And I was like, if the oil price goes lower, keeps on going low back then and stays low for a while, and the rally's not that much, and some of these oil producers go bankrupt and the oil production drops through the pipeline, that cash flow that the pipeline companies were expecting is not going to be there. It's going to drop. So it really depends. It's not a complete question. So if you want capital gains, if you're more high risk, the exploration companies, but that's going to be very, very high risk. Your reward would be higher. It's all about risk and reward. So if you want safety, if you want safer risk return, it'll be the larger oil companies like a Royal Dutch Shell or a Chevron. ExxonMobil has balance sheet problems. BP has higher costs. I've covered this in articles behind the paywall for my over 1,000, barely over 1,000, because I've had like 40 people cancel in the last couple days. Around 40 people. Patreon. Even though I put a ton of articles there, there's at least 1 or 2 new articles a week normally. I try to put out 1 new article a week, or audio podcast or chart. There's normally more than 1, but I try to put out 1 a week. It's only $5 a month too. So it just depends. It depends on what your goals and risk tolerance are. If you want income, it's going to be different types of oil exposure. In general, though, if the economy rolls over, the oil price could go back down. So we have had supply cuts, but demand is dicey. And if demand falls again, if the economy rolls over, we could be back. I really didn't expect this much of a strong oil rally. I think I expected like 20 to 35 a barrel for a while. And it rallied quite a bit more than I thought. But now we may roll. I think it rallied more because there was more short covering, and also there was the contango trade with the tankers. There was a lot of people storing oil. I'll cover this in an article for my patrons. I have some amazing charts and graphs from sources I found with the amount of oil that's being stored in the U.S. and China. It's insane. Again, for a $5 super chat, it's tough to answer all the different questions there about the oil market. The oil market's fairly complex, and I don't know your investment goals and objectives and how much risk you can take. Okay, super chat from Timothy Zero. Thank you for the super chat. Is it true the stimulus check and unemployment boost are drawn from the Treasury General account? They could be. They could be, because Jerome Powell was saying on his 60 Minutes interview that the Fed wants to finance more of it. So it just depends. Lynn Alden has talked about this, that the goal is to actually reduce by the end of the year the Treasury General account in half, but it's still going up. So the Treasury General account is still going up. It's over 1.6 trillion, but the goal was to get it down to 800 billion by the end of this year. Which would be, if Trump and Mnuchin are able to deploy hundreds of billions of dollars or more before the election, I think that might be a big boost to them to getting Trump reelected. I mean, none of this occurs without the Fed. So saying that the Treasury's doing all this, it's the Fed. Because look at all the rules changes. I talk about what's rule number one. Rule number one is the rules changes. Okay, the Fed is only legally allowed to buy, technically, U.S. Treasuries and mortgage-backed securities. And in the past, I don't even think that we're allowed to buy mortgage-backed securities, but that was rules changed from 2008. So anytime there's a crisis or a problem, the rules get changed, the rules bend. This is the environment we're in. None of this is possible without the world reserve currency and the Fed. This is why Austrian school economists and libertarians are so critical of the Fed and other central banks, because none of this shenanigans is possible without a central bank. $2 super chat from Abbey Road. Thank you for the super chat. $15 super chat from Dmitry Shmerkovich. Thank you. He's also a Patreon account contributor, one of over 1,000 still. Hopefully more people will sign up. It's only $5 a month, although maybe I will start writing more articles and they will be for $20 or $50 a month. We'll see. Or I'll start moving a few of the articles then instead up to the $20 or $50 because some of them are really detailed. There's a euro dollar and derivatives one. I spent over a month on and off working on it. That's behind the paywall. That was from, I think, mid-June. Okay, Jason, thank you for all your work. You're welcome. I appreciate it. Thanks for the kind words. Get well soon. Okay, what do you make of the low VIX? What is your opinion of spike in OTM VIX calls for the week of July 22nd and no other week in July? Okay, so as I've talked about with you, Dimitri, in messages in Patreon, I think the Fed has made it very clear that they're trying to manipulate the VIX back down. Also, you are trading against trillions of dollars. So if you do make a lot of money being long VIX, you better start taking profits if you get big pops, because on the other side of the trade with you, you're against an enormous group of Wall Street people, hedge funds, the leverage short vol trade, which is over 3 trillion, according to volatility hedge fund manager Christopher Cole of Artemis Capital. So you're up against trillions of dollars on the other side of the trade and the Fed, who want to smash volatility back down. Now, are they always going to be successful? Are they going to totally smash volatility and not allow any temporary spikes like what we had in February, March, April, no, they're not going to be successful in totally stopping volatility, but they will be able to reduce it or slow it down or make sure it's very temporary. So being long VIX is a very short-term trade, and if you do have some big profits, you have to take, in my opinion, you have to take money off the table. So if you get big VIX pops, I would not maintain the position. I would, if you're going to trade that, in my opinion, I would keep cash after you have profits from those trades and then wait until the VIX gets smashed back down by the leverage short vol trade. Former hedge fund manager Jesse Felder has talked about this a lot. I think he talked about this in a number of different interviews. I can't remember if he talked about this on his long George Gammon interview or his Keith McCullough from Hedgeye interview. I think it's in the long Keith McCullough interview on Hedgeye, where Jesse Felder was outlining of the Felder report and former hedge fund manager that he thinks the leverage short vol trade is funding a lot of other risky bets all across different asset classes. So if Jesse Felder is right about that, the other side of the trade that you're trying to do is almost unlimited, many, many trillions. So it's going to be really tough for you to get a lot of profitable long trades on long VIX. So when you do get profits, you should strongly think, in my opinion, about actually taking money off the table. So if the VIX does go back to, 40, 50, 60, if I was trading those, I would start taking profits off the table and then wait for the Fed, which has said they want to reduce volatility, calm the markets down, whether that's by buying more individual corporate bonds now or 2 or 3 a.m. S&P E futures minis, whoever knows. Someone's buying them. I don't know who's doing it exactly. So the other side of the trade, Dimitri, they don't want people making a lot of money being long VIX, and it's only going to be for short periods of time. Just like now with all the rules changes, you can only make, maybe there's a small, I wrote an article about this recently, there's probably only a small window now to make money shorting. Luke Roman has talked about this. It's like U.S. government, U.S. Treasury, because of how much capital gains taxes are needed from stocks, bonds, real estate. It's official government policy and Fed policy to manipulate asset prices high in nominal value. So if you're short a bunch of companies or a bunch of industries like the banks or commercial real estate, there might only be, this is just my opinion, there might only be a very short window before the Fed changes the rules again, comes up with the right magic cocktail of manipulation and rules changes and press release manipulation bluffs. This is the new normal now. It sucks. JB Weld, thank you for the super chat. He says, just buy stocks. The Fed just paves over bad data with inflationary printing, almost guaranteeing assets appreciation, fake as it is. Thanks for the hard work. You're welcome. The problem is some of these companies, the fundamentals may deteriorate. So we're going to see the Q2 earnings data. We're going to start to see that in the coming weeks, how bad it is. A lot of these companies were promising that the Q1 earnings data was the worst of it. We're going to see if they were telling the truth or not. I suspect that we're going to find out the Q2 numbers for a lot of these companies in different industries was worse than even the Q1. So we may see, I would watch some of the stocks that report earnings and see how much some of them drop. So if we see some of these companies drop 10, 20% in a few days or a week or more than that, that'll be, there's a lot of things that, there's a lot of signals. It's getting late. And also I've been talking for almost 50 minutes straight without a water break. There's a lot of signals that the stock market may be rolling over temporarily and it may need the next round. This is ridiculous. Obviously, I'm not in favor of it, but the next round of MMT checks, and they have to figure out what they're going to do with the extra $600 a week of unemployment if they're going to extend that, and what they're going to do with the PPP loans, which are going to start expiring. The loan grants are going to start expiring in the next couple weeks, which means that more people could be fired because those small businesses, they met the terms of the loan grant, and it can be waived off. So we could have a big rollover in the next 6 weeks. It depends on what Congress decides to do if they can agree to the next round of MMT stimulus checks, and then with the PPP loans if they're extended, and the unemployment. We'll see. If there's a delay, let's say Congress can't agree on anything. Let's say the Democrats in Congress decide they want to hold things up as long as possible to hurt Trump in the before the election, and things get delayed another 6 weeks or 2 months. I could see then there would be another potential stock market crash scenario, but then it might just be short. Okay, super chat from Jonathan. Thank you, Jonathan. He's also a Patreon account contributor. Is IAU? I haven't looked at IAU in a long time. Let me just pull it up. iShares Gold Trust. Oh, I don't like any of those. The only gold trusts I like are the Sprott ones. So the Sprott Central Fund, the Sprott Gold Trust, the Sprott Silver Fund. I don't like IAU or GLD or SLV. I don't like any of those. The Sprott Trust, I think you can lock in long-term capital gains taxes. So I think from a tax perspective, it is much more beneficial. It's not taxed as a collectible. Same amount of counterparty risk as GLD. I haven't read the prospectus for IAU, so I can't comment on that. But I have looked at the prospectus for GLD, and I'm staying away from that. Do I know a good silver ETF? Do you mean a physical silver ETF or silver miners ETF? Because there's a silver miners ETF that is SILJ that my friend Andrew Chanin started. Sprott has a physical silver ETF, and I think also it's a physical silver trust, not an ETF. And I think you get a long-term capital gains tax if you just buy and hold it. The only ones I trust are like the two Sprott ones, which are PSLV and PHYS. Also, Sprott bought the Central Fund. So that's now the Sprott Central Fund, and the Sprott Central Fund is a mix of gold and silver. So Sprott owns 3. Super chat from Animalia Nicole Chrysalis. Thank you. Thoughts on Brett Weinstein's Unity 2020 plan? I don't even know what the Unity 2020 plan is. Is that Democrats and Republicans working together? Because it seems things are going more and more extreme. If you've seen the historical fiction show on Netflix, Babylon Berlin, it's starting to remind me of that. Which it's a good show. It's just not a happy show. And that's where there was communists, there was socialists and communists in Weimar Republic, Germany, and then also Nazis. So they were fighting with each other in the streets. And then there was big government and corruption in the government. It was a mess. Okay, so I can't comment on Brett Weinstein's Unity 2020 plan. I haven't looked at it, so I don't know what it is. I don't know what it is. What is the best option to remedy corruption on the state and federal level, in your opinion? We have to get back to a meritocracy. I think people, the amount of waste, fraud, corruption, and abuse at all levels of government right now is insane. The DC metro area is very, very well compared to a lot of other areas. The amount of problems in all the federal government agencies with just wasted capital, or people getting unbid contracts, or employees committing felonies and not going to prison. Normally they're Democrats almost all the time, because almost all the federal government employees are Democrats here. Look at the amount of voting that occurs. Like in DC, I think it was in the 2016 election, it was over 90% Hillary Clinton. And in here in the Northern Virginia area, I live right outside of DC, Northern Virginia area, it's almost all Democrat now. Well, we need to reduce the size of government, but that means people need to take more personal responsibility. As long as the U.S. has a world reserve currency, as long as there's a as long as there's a fiat currency and a debt-based fiat currency, the currency supply is going to keep growing. Credit and currency is going to keep growing. I spoke to a bank lobbyist off the record many years ago. This was after the 2008 financial crisis, and he said like he was accumulating gold on dips. So every time the gold price got smashed, he was accumulating gold. And he said, look, the entire system, it's all fiat currency. That's the main problem. And he said the whole system's going to have to blow up before there's any major changes here in DC for the federal government. That's what he told me in his opinion. And this was maybe 2011 or 12. So these federal government agents, a lot of, look, the Securities and Exchange Commission, are they doing anything with Elon Musk? Did they do anything with Luckin Coffee? Are they holding Chinese companies to American accounting standards? I mean, I could go on and on about every single government agency, the problems. You have the Department of Energy banning liquid fluoride molten salt thorium reactor, making sure it can't get permitting, can't get funding here in the U.S. You have viable energy that should get research and development that's not. You have unbidded contracts. You have contracts going to friends. The worst, Wall Street, the financial industry, is a big waster of capital. The other big waste one is the Pentagon. Unless you have friends or family that have lived in DC or the DC metro area, or you've lived here for at least a couple years, you don't understand how much power the Pentagon and the military-industrial complex, military-industrial and information complex has in the DC metro area with the economy, with jobs. So almost all the jobs here that are not directly with the federal government and federal government agency are directly or indirectly tied to the Pentagon and the military-industrial and information complex here in the DC metro area. So if you are a consultant and you work for Accenture or Booz Allen Hamilton or Deloitte, or some of these other multi-billion-dollar consulting companies, you have to have a security clearance. You have to have a security clearance, and most likely you're doing work for the Pentagon. If you're a military subcontractor, of course, you're doing work for the Pentagon, or a military, or a private contractor, or a military-industrial complex company. So almost all the jobs here are tied directly or indirectly to the military budget in the DC metro area. Okay, I think that's pretty much it for this show. I want to thank I'm getting really tired. It's over 50 minutes talking with like one little water break. I want to thank my over 1,000 still Patreon account contributors. If you want to take a look at the content behind the paywall, there is a lot of articles, research, information, analysis, and financial education. I try to weave in a lot of education into the articles, explaining complex topics, linking to definitions. There's articles about Newmont Mining and Barrick Gold, royalty and streaming companies. Over the last couple months, there was a ton of oil articles I have to put out if I'm feeling good enough in the next couple weeks. Hopefully another oil market update. Hopefully I can get it done this weekend. I also have 2 interviews that were already recorded. I have to edit those. I'm not sure if I have the energy to edit them tonight, but maybe I'll get to that tomorrow. I have an interview done with David McElvaney that I finished this past Friday, so about a week ago. That interview, just have to edit it. That's done. And then an interview with Yuri Maltsev. If you're not familiar with Yuri Maltsev, he is an PhD economist, and he's a senior fellow at the Mises Institute. He escaped the Soviet Union. He defected. So there is a lot of good insights about the crazy Marxist tactics that are happening right now in the U.S. economy with divide and conquer strategies, and comparing it to what happened in the Soviet Union and the Soviet Revolution. So I really enjoyed that interview with Yuri Maltsev. It's not solely about the economy, though. It's more about culture and how the U.S. has changed a lot over the decades. And also, this was the funniest part of the interview. I enjoyed it, actually, because I asked him about the fake government economic data in the Soviet Union, and he just went on and on about how the Soviet Union faked the economic data. It was great. Okay, well, I'm getting tired. I could go on and on and on about rants about corruption in the federal government at all levels of government, but I'm getting tired. So unfortunately, we need to shrink the size of government. It is too big. We need to get back to a meritocracy. So if you're going to work in, if we're going to reduce the size of government, but first maybe we're going to do it in stages. If you're going to work in one of these federal government agencies, you should probably meet the qualifications. And there's a lot of people working in some of these federal government agencies that don't meet any of the qualifications at all. But somehow they got a job, and somehow now they're making $70,000, $80,000, $90,000, $100,000 a year with cushy retirement benefits and a government retirement plan of investments, and they can't get fired. So that needs to change. Did Trump drain the swamp? No. Did he cut the size of government? No. Now the Trump supporters talk about the 10,000 rules and regulations he's cut. Look, I'm here in DC and they haven't cut any of the regulators, and the regulators at all these government agencies hate him, except for the political appointees at the top. But pretty much all the other government employees at all the different government agencies below the political appointees hate Trump. Okay, that's it for tonight. Thank you very much to my Patreon account contributors, my monthly PayPal contributors, and people who tip me once in a while through my website and on PayPal, one-time donation, or crypto. I will end now before my voice goes. Oh, last point. I just remembered. This is just housekeeping. So, hopefully before the end of the year, I will be able to upgrade my website, the Wall Street for Main Street website. So if you are a good WordPress developer and you could send me some samples, website samples of work you've done, or you know someone referrals, you can email me and we could talk there. So I'm not trying to get the website upgraded in the next couple weeks or month or two. Hopefully by the end of the year, though, I do want to make the investments and upgrade the website, because we don't want what happened with Stefan Molyneux and some of the other people losing their channels. I need a backup plan.